Welcome to the Valmika Property Investing Podcast. I'm JP, your host and the founder of Valmika Buyers Agency. With my background in investment banking, I'm here to share Wall Street tips and secrets for building a top 4% property portfolio. Let's dive into the world of property investment together. Welcome to another episode. This episode is titled Demystifying Commercial Property Investments in Australia. I am going to speak about the strategies for success relating to this. Commercial property is a big unknown. It's not as common as investing in residential property. And as a result, people fear the unknown. But there's honestly nothing to fear in commercial property. It can form a really great, successful part of your investment portfolio. And we strongly encourage this form of investment in Valmika Buyers Agency. So in this podcast, I'm going to lay your fears to rest regarding the commercial property investment space. So what we're going to speak about? I'm going to speak about the different types or ways you can invest in commercial property. And I'm going to give you some examples on this. Then I'm going to speak about the pillars of smart investment. So the pillars relating to commercial property to make that investment decision a smart one. And I'm going to give you an example on this as well. Then lastly, I'm going to speak to you about the financing strategies relating to commercial property investment. So let's get straight to it. What are the entry points for aspiring investors? So people who have, or investors who have not invested in commercial property before, think it's a much more expensive way, or in other words, you need a lot more capital in order to invest in this space. And this is simply not true. And you can invest in the space with relatively little capital. And I'll explain to you now how you can do that. So what are the various ways to invest in commercial property? The first one, and the most obvious one, is through direct ownership. So the traditional approach would involve purchasing commercial property outright. This would offer you the potential for higher returns, but requires a lot more capital. And by saying that it requires more capital, it's not a significant amount more. So let's compare that to residential property. Residential property, on average, you can get up to 90% gearing, so 90% debt. Whereas in commercial property, the banks are a little bit more conservative, and they generally tend to require a 30% deposit as opposed to a 10% deposit for minimum, that is, for residential. I have seen 20% deposits, but nothing less than that. So it requires a little bit more capital out front in order to get your first property. But the benefit of direct ownership is that you get to choose the commercial property. And if you choose it right, you can gather a lot of wealth a lot quicker than you would in residential property. The other way, let's say you've got less capital, is through property funds. So what are property funds? So these are pooled investment vehicles that allow investors to participate in a diversified portfolio of commercial properties with lower initial investment compared to direct ownership. So if you wanted to get exposure to commercial property but didn't have the capital to do it, you can invest smaller amounts into a property fund. And in that property fund, there'll be a property fund manager, and their responsibilities will lie on that person to invest their capital. The third option, which you can enter into, and it requires even less capital, is through what we call REITs. REITs are real estate investment trusts. So these are listed on the stock exchange. So you can purchase REITs like you would shares, And this gives you exposure to a diversified range of commercial property. Now, REITs can offer high liquidity as well, or they do offer high liquidity, so you can buy into them and sell out of them quite easily, like you do with listed stocks. They have professional management, but the returns might be a bit lower than direct ownership and property funds. A word of caution: the REITs at the moment have got a lot of exposure, especially the REITs that have got offices in them. So there's a lot of exposure to office blocks. As we've seen post the pandemic era, and especially in locations like Melbourne, for example, there hasn't been the return to offices from the working community as it has in some other cities. And as a result, office space vacancies are quite high amongst developed economies and in developed cities. Now, REITs have a lot of exposure to this. The actual valuations aren't reflecting this as of yet. They are still showing what I tend to think artificially high valuations, which need to be adjusted lower. So I would caution against investing in REITs that have got a lot of exposure to office space in particular. Okay, so what are the statistics around these three different types of, or three different ways to invest in commercial property? So according to the Urban Land Institute, around 30% of commercial real estate investments in Australia occurs through direct ownership, while property funds and REITs account for the remaining 70%. Right, let's end off with a simple example. So let's say you have $200,000 for a commercial property investment. Direct ownership might be challenging to find a suitable property within this budget. However, you can invest in a diversified property fund, potentially spreading your investment across several properties and mitigating risk. So there's always a way to get exposure to commercial property investments through those funds. Moving on to the next topic. So what are the pillars of smart investment when it comes to commercial property? Well, the first one, and it's no surprise, is location, location, location. The mantra holds true in commercial property as well as it does in residential. So what are the factors to consider? Surrounding demographics is the first one. Are there businesses that would thrive as tenants in your chosen property type? For example, young professionals for office space, families for retail stores, etc. The second point here, accessibility. Is the property easily accessible by public transport and major roads for the tenants and customers? If it is, it adds a lot of value to these investments. So it's definitely worthwhile looking at the accessibility of the asset. Thirdly, the infrastructure. Are there essential amenities nearby? For example, cafes, restaurants that enhance the property's value for tenants. Having these amenities close by makes the attractiveness of the asset a lot more, and as a result, the valuation attached to it. When looking to invest in any form of property, and it holds true for commercial, due diligence is key. So before investing, you must conduct a thorough due diligence. And what does that entail? Firstly, property inspections. Identify any potential maintenance issues or structural concerns. Secondly, and this is a little bit different to residential, is there is a lot more emphasis on the lease agreements. You need to scrutinize lease terms, the tenant financials, and expiration dates to assess potential risks and income stability within the assets. Leases are the key to commercial property. It's all about cash flow. Therefore, a strong lease with a good tenant is very important. Thirdly, market research. Understand rental rates for similar properties in the area to ensure you're getting a fair return on your investment. Okay, let's look at an example. So imagine you're considering a retail space in a suburban area. Due diligence might involve analyzing population dynamics. For example, the presence of young families suggests potential for child-focused stores, for example, and also checking traffic flow patterns and understanding the lease agreement with the current tenant. This ensures rental income aligns with market rates and the lease term provides stability. Simple in concept, just make sure you've got yourself a good team surrounding you, third-party professionals to check this property. It's well worth the investment. Last topic, let's look into financing strategies that will fuel your commercial property investment. The first one and the most obvious one is traditional bank loans. Many investors utilize bank loans to finance commercial property. Important things to consider here are the loan terms, such as interest rates, down payment requirements, but they will vary depending on your financial situation and the property type as well. The second type of financing strategies, which we like to use a lot at our agency, is mezzanine financing. So what is this? So this option of financing bridges the gap between senior debt, which is the bank loan, and equity, which is your cash contribution. So mezzanine lenders will provide additional capital, albeit at a higher interest rate than a traditional loan. But this interest rate is typically lower than what an equity investor would require. So remember that equity into a commercial property or any property that is the most expensive form of funding, because this is the form of funding that requires the most returns. So if you can supplement it with cheaper forms of funding where it's capped, like for example with debt financing, this enables any uplift to be given back to your equity investors. This is something we can go into a lot more detail if you would like. So leave a comment if you would like me to go into more of this and I can explain. But mezzanine financing, we can get very creative. It's typically for more advanced investors, but what we like to do is we have some international investors, and I'll give you an example. One particular Japanese client of ours has got access to way cheaper funding in debt funding, that is, in Japan. So we make use of interest rate derivatives to hedge out his currency exposure and switch a Japanese loan for an Australian loan. This derivative is called cross-currency basis swaps. I'm not going to go into much detail there, but what it does is it takes advantage of the interest rate differential between Australia and Japan. Australia's interest rates are much higher, and the convexity measure between them, and allows him to get a significantly cheaper related Australian debt swap that he can use towards his debt financing and boost his returns in commercial property. It's a more advanced topic. We can go into it if you'd like. Leave me a comment. The third type of funding that we look for is joint ventures. So if you partner with other investors, it allows you to pool resources, share expertise, and potentially acquire a larger or more complex commercial property. However, if you're going to do this, remember that clear communication and a well-defined joint venture agreement are crucial for success. I hope you enjoyed today's podcast. If you found it valuable, please leave us a like. It'll help us keep the lights on, and we look forward to speaking with you in the next one. Thanks for tuning in to today's episode of the Valmika Property Investing Podcast. If you're interested in our services, please visit us at valmikaproperty.com. Remember, the content shared in this podcast is for entertainment purposes only. For personalized financial advice, always consult your trusted financial advisor or professional. See you in the next episode.